Are student loan payments tax deductible? The answer is no, but it's a little bit more complicated than just a no. So you can deduct a little bit of student loan interest if you have a low enough income. That income needs to be generally in the 80K, 70 to 85K range or below as a single borrower, or 140K to about 170K or below if you are a married couple. And if you're able to deduct something, you're only going to be able to deduct a maximum of about $2,500, and that's just in interest that you paid. And that's not a lot. Basically, that's the equivalent of a federal loan with $42,000 worth of principal. So if you have anything more than that, your interest is basically going to be non-deductible. And certainly the principal payments are going to be non-deductible. What does this mean when your student loans are not tax deductible? In that event, basically any debt that is tax deductible is much better debt to keep around than your student loans are. So for example, if you have mortgage debt or if you have business debt that you are able to write off, that debt you want to keep around for as long as possible. Whereas your student loans, if you're sure that you need to pay them off because you either owe less than you earn or you have private loans you have to pay off, then you know that you want to get rid of that debt. And you know that if you have any credit card debt that might have super high interest rates or payday loans or anything like that, obviously that would come first. But after that, you would need to want to attack the student loans next because of that lack of a tax deduction. Now, what happened if they did make student loan payments tax deductible? In that event, I predict that a lot of schools would raise their prices even more than they already have because consumers would be less sensitive to paying their student loans because they'd be able to deduct it on their taxes. And then people would take longer and longer to pay off their loans because they would want to keep around the tax deduction. That is not a smart thing, even if they did make student loan payments tax deductible to keep them around, unless you're going for forgiveness. If you're going for a forgiveness-based strategy where you're paying based on your income for a couple decades, or you're doing the loan forgiveness in the private or in the public sector rather, that would be something that you would want to consider keeping your loans around for because you want to pay as little as possible because you're trying to get as big of a balance forgiven as possible. But for student loan payments being tax deductible, there used to be a little bit of a loophole that you could make them tax deductible. You could borrow, I believe it was about $100,000 of equity from a home equity line of credit and use that to pay off some of your student loans, and that new line of credit would be tax deductible. So that was a roundabout way of doing it if you had equity in your home and could qualify for a HELOC. Now the problem is that got eliminated with the Tax Cuts and Jobs Act at the end of 2017. So now you're no longer allowed to use home equity line of credit money to pay off a non-real estate related cost, which is student loans is certainly not a real estate related cost. So that means that it's not tax deductible anymore. So there's really no good way to get a tax deduction for paying your student loans. And so what that tells you is you should hate your student loans and pay them off as fast as possible, or keep them around because you're going for some sort of forgiveness strategy. And if you're trying to figure out how to maximize that strategy, that's what we specialize in. Go to studentloanplanner.com/help and we'll help you figure out the most efficient way to pay back your student loans.